Hello everybody, it's Lucas Rogers speaking here from the Rogers Property Group, and I'd like to welcome you along to today's webinar. Now the title of today's webinar is The Best of Both Worlds, meaning you can get positive cash flow and capital growth from your property portfolio. Now a lot of people think that that's not true. People think that you forgo cash flow for capital growth and you forgo capital growth for cash flow. But I'm here to tell you today that that is just not true. If you structure your investments correctly, you can have the best of both worlds. You can get both positive cash flow and capital growth as well. You've just really got to know what you're doing and know how to put all the parts of the jigsaw puzzle together. So what I'm going to do in the webinar is I'm going to explain that to you. And not only that, is I'm going to give you some tips and tricks on how to turbocharge your cash flow from your property as well, or from your property portfolio, I should say, as well. So let's kick on with it. Now, some contact details for us. Guys, if you have any questions, if you want to contact me, you can get in touch with me at info@rogerspropertygroup.com.au, or you can give us a call on 1300 148 178. And look, I really encourage you to follow us on social media. That keeps you up to date with everything that's happening in the market. There's lots of tips and tricks that I do send out. So you can follow us on Facebook, give us a like there, or you can also follow us on Instagram as well. So moving right along, today's webinar is going to be for you if you want to achieve financial freedom for both yourself and your family. Now, I'm going to take a stab in the dark and say that that's probably going to be everybody who's listening to this particular webinar, because of the fact that if you weren't listening to it, then if you weren't interested in getting financial freedom, you're probably not listening anyway. So I'll take that as a given anyway. But if you want your investments not to affect your lifestyle, so many people are frightened of actually getting involved with property investment, especially younger people who have a great lifestyle. They like to go out to dinner, they like to go out and have fun and spend a bit of money, but they think if they get started in property investment, their lifestyle is going to be non-existent because it's going to soak up all their money. I'm here to tell you today that that's not true. You can actually buy an investment property, and not only is it going to have capital growth, so it's going to go upwards in value, but it'll also put a few dollars back in your pocket. And I'm going to show you how that actually happens as well. So if you want your investments not to affect your lifestyle, then please listen on. If you want cash flow positive property, well, that's what we're here to talk about. Building up a property portfolio and getting it to be cash flow positive, and some tips and tricks on how to do that. And also, if you don't want to retire on the poverty line, now, I was reading some interesting information yesterday that the poverty line in Australia is considered anybody who's earning $400 a week or less. That's crazy, isn't it? $400 a week or less, and you are on the poverty line. Now, what a lot of people don't realise is that the Australian pension is actually around $390 to $400 per week. So if you are retiring on the pension, you are effectively retiring on the poverty line, which is really scary, because a lot of people have that idea that, well, when they finish work, there's always that backup of the pension. That's not where you want to be. It's really not where you want to be. And I speak on behalf of the federal government, which I'll get into a little bit later, and they request me to do or to speak on their behalf, teaching people how to make money through property investing, because they want to get people off the pension. And the reason why they get people off the pension is because there's less taxpayers now for every pensioner. So you don't want to be one of those people who's it's not a lot of dignity living on the poverty line, that's for sure. So let's get ourselves out of that. If you're the sort of person who thinks you're paying too much tax, and let me tell you, everybody that I speak to thinks they're paying too much tax. Whether you're paying 10 grand in tax or $100,000, $200,000 a year in tax, everybody thinks they're paying too much tax. And to be honest with you, most people are. And most people don't have tax minimisation strategies in place to reduce the amount they're actually paying. I remember I saw an interview with Kerry Packer, and he said, he was Australia's richest man at the time, and he said, if any Australian doesn't have tax minimisation strategies in place, they need their head read. And I thought that was a great saying, and I think it's very, very true. Everybody can legally minimise their tax, and there's no reason why you shouldn't be doing that as well. Okay, and understanding, listen to this if you understand that wealth building or building wealth through property does take time. I'm not going to sit on this webinar and dazzle you and say, okay, well, look, everybody's going to be a millionaire within the space of, 2 or 3 years. It does take time to build up a property portfolio that's significant amount to not only be proud of, but to also give you a decent income in retirement is going to take, 5, 10, maybe 15 years, depending on what sort of outcome that you want from your property investment or what you want in retirement. Guys, turn this webinar off if you want to make a quick buck. I shouldn't really say that because, a lot of people do like to make a quick buck, but I want you to understand that property is not a quick buck scenario. You're not going to, as I just said it in the previous slide, you're not going to make $1 million overnight. It does happen. I have to admit, it does happen. In Sydney, over the last few years, the property market has gone up significantly in the last, say, 5 years, and people have doubled their money, but that's generally an anomaly. Property goes up at around 8 to 10% per annum. So, if you invest in a $500,000-$600,000 property, you can anticipate your capital growth of around $50,000 to $60,000 per annum. So just don't get into property with the anticipation of a quick buck. Guys, if you're a procrastinator, you are going to find it very, very difficult to ever invest, whether it's property, shares, whatever it is. If you're a procrastinator, you're going to find it very, very difficult to build wealth, because procrastination is just fear, and it's going to stop you from actually getting into the market and doing anything. Procrastinator comes under the guise of all sorts of things. People hide behind the veil of research and so on. It's funny. I was speaking at a Sydney property expo last year, and a lady came up to me, and she was a nice woman, and she said, I love your thing, and I love your speech, and I'm looking to get started in property investment, and I've been researching the Sydney market for the last 5 years. And I was like, you've been researching for the last 5 years? The market in the last calendar year went up by $150,000. That's $3,000 per week. I said that, over the last 4 to 5 years, the market's gone up by $600,000. And she just couldn't fathom that the market was going up faster than she could save. And so she was just procrastinating, hiding behind the veil of research, and she would never ever, I can guarantee you that woman will never ever get involved with property investment because she just procrastinates too hard. So if you're a procrastinator, then get out of that or look at doing something else, because you'll never build up wealth. Think that property investment is only for the rich. Look, that's just not true. Property investment is not for the rich. I sent out a recent newsletter talking about who were the biggest negative gearers in Australia, and would you believe that school teachers on $80,000 or less are the biggest negative gearers in Australia? It's hard to believe, isn't it? So to say that property investment is only for the rich is an absolute load of nonsense. Everybody should be doing it, and everybody has to invest. It doesn't matter what sort of income that you're on. If you're a negative person, this webinar is probably not going to be for you. If you're the sort of person that says everything doesn't work, and that's not right, and it doesn't work, and that can't happen, and my uncle lost all his money. If you're a negative person, then that's going to create fear for you, and it means that you're not going to get involved in property investment or any sort of investing for that matter. It's going to be very, very difficult for you to build any sort of wealth at all. So a little bit of background of me. There's a nice cheesy photo of me for you guys because you're not able to see me today. Look, my background is I'm a chartered accountant. I used to work for one of the big 4 accounting firms before I moved to London, and I worked in investment banking in London for 7 years. I worked for a couple of the big investment banks over there, Swiss American investment banks. I moved back to Australia in 2004. And I got involved with property investment, property finance, and property development. I also am a qualified financial planner. I'm a qualified mortgage broker. I've had more than 13 years experience in property finance. I've done a lot of capital raising, and I've been involved with hundreds of millions of dollars in property investment, and I have a sizable property portfolio myself as well. So look, not only do I have the right qualifications to be giving people advice, I've also had plenty of experience. And not only that is I've also written a book on property investment. It's called The Complete Guide to Property Investing in Australia. And look, I think it's a great read, but there is a chance that I might be biased. But look, I really do think it's a great read, and I'd love everybody to have a free copy. So please send me an email at info@rogerspropertygroup.com.au. That's info@rogerspropertygroup.com.au, and I'll make sure a free copy gets sent out to you. It retails for about $30, but more than happy for anybody listening to the webinar today to get a free copy, so jump on. Look, I do a lot of public speaking. I speak on behalf of the Australian federal government, teaching the general public on how to build wealth and to make money through property investing. I've been speaking on behalf of the federal government for over 10 years, and I do it right across Australia, from Perth all the way to Queensland. And the reason why the government gets me to do that on their behalf is because of the fact that they, as I said in a previous slide before, that they want people to get off the pension. They want people to become self-funded retirees. They don't want people, soaking up money for the pension, because the bottom line is there's less taxpayers now than there have been ever, as compared to every pensioner, because we have an aging population. So they want to try and make people become self-funded retirees. So they get me to stand up there in front of a crowd. They advertise, get people in auditorium or whatever, and I speak to them about how to make money and build wealth through property investing. I speak on behalf of the National Australia Bank, so I speak to their customers, in a workshop format, teaching them how to build wealth through property investment. I spoke on behalf of Westpac in the past, talking to various branch managers and customers about how to make money through property. And I also speak on behalf of the Queensland Police Department. So as the recruits have come through the academy, I've spoken to them about how to make money through property as well. So I'm, one of the leading property educators throughout Australia, and I've certainly been accredited as such, and I've got the qualifications to do so. But look, enough of my background. I remember when I first got started in property investing, and it was a really scary thing. There was so many questions that I couldn't find answers for. Where do you buy? What do you buy? Do you buy houses? Do you buy land? Do you buy units? Do you buy stuff off the plan? What is it? Or do we buy commercial property? And I never knew how to maximize my returns while minimizing my tax. Most importantly, I wanted to avoid getting ripped off. And what I found strange was some people had a property portfolio, very few, of 10 properties, and some people could never get past one. And I never really knew what that was, and after years of experience, I've managed to work it out, and that's what I'm going to share with you today. So hopefully you can speed up your wealth building and your property portfolio. Guys, today is going to be divided up into 3 distinct parts. And in fact, this webinar is going to be split into 3 parts. So first of all, we're going to be talking about you, okay? Getting your mindset right to be successful in life in general, and more importantly, well, not more importantly, but importantly, to be successful in property investing. Okay, we're going to look at what successful people do. Secondly, we're going to be looking at finance. Different financial structures that you can use to buy property in, what makes a good loan, some tips and tricks to avoid when it comes to financing assets, and that's going to be very important. And then finally, of course, we're going to be looking at property, where to buy, what to look for, what makes a good investment, how to identify a hot spot, and very, very importantly, things to avoid and how to keep your money nice and safe. So guys, today we're just going to be looking at you and getting your mindset right. And then in part 2, we'll look at finance. And then in part 3, we'll look at property. So I really encourage you to listen to all 3 parts. And you can see there on this particular slide, I've put them on an equilibrium triangle. And there's a reason for that, is that each part of the webinar is just as important as the other. Each part of property investment of this, finance and property, is just as important as one another, because you can have the best property available, but if you don't have your finance set up correctly, then you're going to fall over. And likewise, if you can have the best finance package and you can, you have a great interest rate and all those sorts of things, but if you go and pick a dud in regards to property, then you're going to fall over as well. So every part intertwines and they're all as important as one another. So please listen to all three parts. Okay, guys, let's kick on. In my time with being involved around successful people and successful property investors, I found that successful property investors will do three things. And the first of those things is they will set goals. You'll find that any successful person in life, whether they're property investors or not, will set goals. Every top businessman, top sportsman, and top sports team will set goals, and then they'll review those goals against performance and then reset those goals. The most important thing that goals do is they give us something to aim towards, something to work towards, a journey, a destination, somewhere where we're going. And what they do is they allow us to make the correct decision as we're moving along our journey. And I'll give you a little metaphor of what I mean, okay? Let's say that you're in Sydney today and you want to drive to Canberra, let's say. Okay, so you walk downstairs out of your building and you get into your car, assuming that you don't have a GPS in your car. What's the first thing that you're going to do? Well, you pull out your map book and you have a look at where you want to go. So you have a look on your map system and then you say, okay, that's where I want to go. Canberra, that's my destination. Okay, that's my goal. Then what you do is you have a look at the other end and say, okay, well, look, where am I now? That's your current, that's your current place. You're in Sydney. You're in a building in Sydney somewhere. So you've worked out where you want to go. You work out where you are at the moment. And then what you can do is you can plan a route on how to get from where you're at the moment to where you want to be from Sydney to Canberra. And that and using that back, that's like a little metaphor as to our financial planning. We have a look at our goal of where we want to be. Okay, we set ourselves a target, a goal, a financial goal. We have a look at what we have in place at the moment, and then we set a plan on how to get there. So when we're driving out of our building in Sydney, we hit our first stop sign and we can either turn left or right. Because we've set a target, a goal of where we want to be, and we've been able to plan a route, we know that only either left or right is going to take us closer to our destination. So it's going to enable us to make the correct financial decision. So if your financial goal is, okay, I want to retire on $100,000 a year, I've currently got $20,000, so I need to put in place X, and I need to get a number of investment properties. If you are then traveling down your journey and you think, okay, well, look, I need to get a new car, are you going to go out and buy a $150,000 brand new motor car? Is that going to take you closer to your goal? No, it's not. That's not the correct decision to make. So by setting goals, it helps us to make these correct decisions, okay? And we need all sorts of goals. We need financial goals. We need personal goals. I set my goals every day. I write down in my diary everything I want to achieve. I set 3-monthly goals and yearly goals as well. And I also have life goals. And I know that I'm making the correct decision all the time because I'm getting closer and closer to my goals. Now, setting goals is one thing. And to set goals, and people have all sorts of ways to encourage themselves to do it. So they have, like visual boards where they cut out photos of things that they want to achieve, etc. And that gives us a warm and fuzzy feeling to set goals. But unless we actually act upon those goals, they're not really goals at all. They're just dreams. People come to property workshops that I have and talk about property investment. And, these people, like my lady at the expo, research and they know all about interest rates and they know all about property prices in the area. But these people are caught up in procrastination and they never actually act. They're hiding behind the veil of research, and they research and they research and they research, and they never act and actually get out there in the market and actually buy a property. Because to make money out of property, you actually, funnily enough, have to own it. So these people, they procrastinate, and they never get into the market. Then the market goes on 5, 10 years down the track, and everybody else who's gotten into the market and purchased property has doubled their money. Then these people wonder why they haven't made any money out of property. Then what they do is they start to blame everybody else. Well, I didn't get into the market because my uncle said that interest rates were going to go up. Or Koshi on TV, in the morning channel, whatever TV station he's on, said that property in Queensland wasn't going to go up, or property in Sydney has done its dash, or whatever it may be. So they blame everybody else. And let me tell you guys, you can't blame anybody else for your decisions. You personally have to take control of your own financial future. And let me say this, if you are not investing at the moment, whether it be shares, whether it be property, whatever it is, if you are not investing at the moment, you need to get yourself into a position where you can invest as soon as you possibly can. Let me repeat that. If you are not investing at the moment, you need to get yourself into a position where you can invest as soon as you possibly can. Because everybody has to invest. If you want a decent chance of retirement, then you must invest, because or else there's no other way. When you finish your work life at 60, 65, whatever it may be, there's a financial cliff sitting there which you don't know is there. It's hidden under one thing and another, but it's there, let me tell you. And the figures don't lie at the end of the day. So if you want to be a successful property investor, you not only have to set goals, you have to actually act upon those goals and get into the market, okay? Buy property. And if you're the sort of person that's thinking, okay, well, look, I might just wait and get on the pension, we're going to have a look at that today and see what sort of lifestyle that you're going to be living on the pension. Finally, successful people will be both persistent and consistent. Successful people are very persistent. They persist and they follow and they push and they pull and they get what they want at the end of the day. And you have to be persistent with property investment because there are bumps in the road. You know, you're dealing with banks and banks do raise interest rates, and you're dealing with tenants and tenants do leave properties. Contrary to popular belief, tenants generally don't wreck properties. They are very good, and most people are very good. There's the odd one that you see on a current affair. I own lots of property, and I've never had anybody hurt, harm, destroy, or wreck one of my properties ever. I've only ever had to evict one person from my property in the whole 13 years that I've owned properties, and that was just a guy who just couldn't afford to pay the rent because the other people that were living in the house with him moved out and he couldn't pay the rent. But he was cool. He didn't wreck the house. We just had to evict him. So there are ups and downs when it comes to property investment. And if you're the sort of person that's going to throw the towel in and sell your properties at the first hiccup in the road, then property may not be for you. You know, you might be better off just putting your money in the bank and getting, inflation. That's really about all you're going to do. But there are going to be ups and downs. So you need to be persistent with the whole thing and hang on for the longer term. And not only that, you also need to be consistent as well. And what do I mean by that? Well, I mean that you need to consistently enter into the market over the longer term. If you just buy one property and you think that your job is done, you think you're going to be retiring wealthy, then you're gravely mistaken. You need to own, a property portfolio with few properties in it. Ross Greenwood got on TV, it was on one of the morning channels, I can't remember what it was, and said, if you're looking at property investment, you need to own 4 properties. 1 to live in, okay, and this is outright, 1 to live in, and 3 to give you cash flow in retirement. So that was his take on it. So you need to own a property portfolio, not just one property. So recapping on this, successful people will set goals, okay? Set financial goals, set personal goals. They'll set goals and then they will act upon those goals to make those goals reality, okay? They act, they don't procrastinate. And then finally, they're persistent in pursuing their goals and they will consistently enter into the market over the longer term. Let's have a look at how Australians are retiring at the moment. You can see here that only 2% of Australians actually retire on an income equal to or greater than 50 grand a year. It's not a lot, is it? 2%. It's hard to believe. Majority of Australians are retiring on an income that's around about the poverty line. Okay, there's 80% of people retiring around about the poverty line, which is $400 per week. It's frightening. It's frightening because I know that the 100 or so people that are listening there today, that means that only 2 of you is going to retire on an income equal to or greater than $50,000 a year. Now, I know that there's people out there listening today who are earning a significant amount more than that. You guys are going to ask yourself a question. Are you prepared to take a step back? And have you put enough assets in place to retire on an income which is going to be suitable to you? Let's say you do want to be in that top 2% of Australians and retire on an income of at least $50,000 a year. Have a little scratch of your head and think, okay, well, how many dollars worth of assets am I going to need to return $50,000 a year? So we work backwards. Okay, well, working it backwards, if we look at a generous yield of around about 5% off our assets, so 5% off your shares, so dividends of 5%, rent of about 5%, or interest of about 5% off cash, which you're probably not going to get, well, that means that you're going to have to own $1 million worth of net assets. And remember, outside of your own home, doesn't include your own home because your own home doesn't give you any income. So you need $1 million worth of assets outside of your own home to return yourself 50 grand a year. So that means $1 million in superannuation, or $1 million in shares with no debt on it, or maybe 3 average priced properties owned outright with no debt. So you can see, ask yourself, well, how many of your friends actually have that asset base? Okay. I sit down with hundreds and hundreds of people and talk to them about property investment. I go through their figures and I can vouch for these numbers that very, very few people are going to retire on an income greater than $50,000 a year. Most people, as the slide says, as the graph says, are going to be retiring on around about the poverty line. It's just what happens. The figures don't lie. Okay, if you're the sort of person that's thinking, okay, well, look, maybe I'll just retire on the pension, let's have a look at that. Well, the pension, the eligible age, my grandfather, he retired at 55 years old and he was entitled to the pension then. But now it's 65 and a half years old and it will go to 70 years old. There's absolutely no doubts about that. Now, and the reason being is, as I've said a couple of times already, we have an ageing population and less taxpayers to take care of those pensioners. So let's put this in perspective. The average lifespan of an Australian male at the moment is around 70 to 80 years. So if you work up until you're 70 years old, you break your back up until you're 70 years old, working, and then finally you're able to retire and you get 9 years left in retirement, it's hardly the golden years, is it? You're not really going to see much of the world at age 70. And what do you get if you retire, if you manage to make it to retirement age and get the pension? Well, the pension is around just a bit over 20 grand a year, which works out to be around about $400 per week. Now, guys, the poverty line is $400 per week, okay? So it's not really where you want to be. When you take out things like your phone costs, your insurances, fuel costs, God forbid if you're renting at that stage, rent, then there's not much left for luxuries at the end of the day. And life on the pension means that overseas travel, gifts, etc. are going to be very much the rarity. So what are you going to need? People always ask me, oh, Lucas, what am I going to need to retire wealthy? Well, there's been lots of different studies done. And I suppose the benchmark is that you're going to need around about 60% of your current family income in retirement to live a comfortable life. So working backwards once again, let's say that I'm on an income of $60,000 and my wife's on an income of, say, $40,000. So our family income is $100,000. So if I need 60% of that, well, in retirement, I'm going to need $60,000 per year to live a comfortable life. So working backwards off a yield, off return of a yield of 5%, that means I'm going to need to have $1.2 million worth of net assets outside of my own home. Okay, so $1.2 million worth of super, etc., to live a comfortable life. It's a fair bit, isn't it? And this is why I think most Australians are actually retiring on the poverty line, because they don't realise how much you actually need to live a comfortable life. Most people think, oh, well, I've got $100,000 in super. That should be fine. But the return off that is $5,000 per year. You can't retire on $5,000 per year. So what happens? You're back on the pension. So you need to give yourself a significant amount of time to build up a decent asset base. Let's have a look at a couple of clients of mine. They're a good example, William and Diane, a great example of what you can do. Now, they were both divorcees and they were starting a new life together. So they didn't have a huge amount. They had good public service jobs, but not huge incomes. They had decent incomes, but not huge incomes. They didn't have a huge amount of assets outside of their superannuation fund, and they thought they'd be on the pension for the rest of their lives, which they certainly didn't want to do. They wanted to do other things. So their goal, they wanted to retire at age 60 with an income of $60,000 per year and have money to travel the world. And I'm sure that if I asked you today what would be one of your goals in retirement, it would definitely be to travel, because I can say to you that 95% of people have that goal in retirement. Because you know when you're retired, you've got plenty of time on your hands. What a great time to travel and see the world. So let's have a look at William and Diane's financials, and we'll see how they're tracking towards their goal of age 60 to retire on $60,000 per year. Okay, they're 40 and 45 years old. Okay, so they have their home value of $650,000, which they owe about $150,000 on. Combined salaries about $160,000, so it's good, but it's not, by no stretch of the imagination is it massive. They have a combined superannuation of $150,000 per year, and 10% of their wages is going into that. So they're getting the superannuation guaranteed contribution of 9.5%, plus they're topping that up with a little bit extra as well. And they also have William had a share portfolio there that he kept from his previous marriage of $70,000, which had nothing owing on that, which was great. So their current incomes in 15 years. Their current outcome in the next 15 years, as we said, they wanted to retire at age 60. So let's work off William's age. So that gives them 15 years, and they want to retire at age 60 on an income of $60,000 a year. Let's have a look at how they're tracking. Well, their superannuation, that's going to go to about $450,000 in the next 15 years, because superannuation is shares based, and shares in Australia, a bit like property, double around about every 10 years. So in 10 years' time, it goes to $300,000, and then from there, it'll go to $450,000. 10% of their $160,000 of their salary is going into superannuation, so that should turn into about $480,000 in the next 15 years. Then their total superannuation will be about $930,000 in 15 years at age 60. Okay. William's share portfolio, that's $70,000. That will double and then go by 50% again. So that'll turn into about $210,000. So in retirement at age 60, William and Diane would have had about $1.1 million worth of net assets outside of their own home. And if you're looking at that, you're probably thinking $1 million, that sounds pretty good, doesn't it? And when we work off our 5% yield, okay, what's it going to give them? Well, it's going to give them about $57,000 per year as an income. Now that looks great. And for those of you sitting there in your chairs looking at this webinar, you're thinking, well, hang on, they're in pretty good shape because they want to retire on $60,000 a year. They've currently got 57, so they're in pretty good shape. But one thing that you haven't taken into account yet, all these figures have been expanded out to the next 15 years. So we're looking at dollars in 15 years' time. And what happens to money every year? It diminishes in power. It diminishes in buying power because of a thing called inflation. And inflation in Australia runs between 2 and 3% per annum. So let's just assume it's 2.5%. It's a little bit lower than that at the moment, but let's assume it's 2.5%. That means that money is going to halve in buying power every 15 years. So what's going to happen to William and Diane's $57,000? Well, it's going to buy the equivalent of $28,000 in today's money. And remember, their goal was setting $60,000 in today's money. So they're about halfway there. So you might be able to look at this, the William and Diane scenario, and say, well, where do I fit within that? And it might give you some indication of where you're going to be. So they're going to retire on $28,000. So we needed to do something for them and their experience. So William and Diane, they knew that they weren't going to retire on their goals with what they had at the moment. So they knew they had a bit of heavy lifting in front of them. So what did we do? Okay, so first of all, we got them to set some goals. And as we said previously, that their goal was to retire at 60 years old with an income of $60,000 per year and have money to be able to travel the world because they're going to have more time on their hands. So that was the initial part. Secondly, we took action. Okay, and what action did we take? We started to build a property portfolio. We started to reduce the amount of tax that they were paying. We redirected the way they were getting paid and restructured a bit of financing so that they were able to pay off their own home faster. So what that did is that reduced their non-tax deductible debt and gave them more money to invest and actually able to live life as well. We also set up a self-managed super fund for them, which was a great way for them to invest because of the fact that it wasn't going to cost them anything out of their own personal cash flow because they already had superannuation going in there. Okay, the outcome. So what happened? These guys, so William and Diane have now begun to realise their financial goals. They're certainly getting ahead. They now own 3 investment properties in 3 years. Plus, on top of that as well, they also own one in their superannuation fund, which is really quite amazing. So that's 4 properties in 3 years. And they also have a higher cash flow as well because what they've been able to do is follow the lead that we've given them and turbocharge their cash flows from their current portfolio that they have. That's stuff that's going to come up in the property section of this particular webinar. So that's part 3. So listen in closely to that. But William and Diane were able to implement some of those strategies and make it much higher cash flow. So they've been very fortunate, and the clients are well on their way to meet their financial goals. So not only are they very fortunate, these clients are actually lucky, and not lucky because of the fact of what they've been able to achieve or their background or anything like that, because they really came from fairly humble sort of beginnings. They were lucky in the fact that well prior to them actually retiring, they were able to identify the fact that they were going to have a shortfall. Remember how I was talking about being in the high-rise in Sydney and you're driving out to Canberra? What they were able to do is have a look at where they want to be early enough and give themselves enough time. Then what they were able to do is have a look at where they are at the moment, and we could help them put a plan in place to get from where they are to where they want to be. Classic goal setting. And that means that they were able to increase the amount of investment they were doing, and they're not going to fall off that financial cliff that most Australians do fall off. And 80% of us are retiring on the poverty line. They weren't going to do that. Okay, so they've done fantastic. So very proud of William and Diane. Most Australians, they're lucky because most Australians never get this opportunity. And a lot of Australians have this attitude of, she'll be right, mate, she'll be right. But let me tell you, she won't be right. The figures don't lie. Okay, if we work out for you that you're going to retire on, $20,000 a year, $10,000 a year, we're not going to be too far off. The figures just don't lie. But as I said, a lot of Australians have the attitude, she'll be right, mate, she'll be right. And what's more, Australians have a real gambler attitude as well, which is not good. We're a real nation of punters. Now, in Melbourne, in Victoria, you get a public holiday for a horse race. Who would have thought that? Interesting fact on gambling in Australia. Do you know we spend more money on gambling than we do on any cultural activity, any social activity, or any sporting activity? We lose well over $1,000 per head to gambling each year. And that makes us Australians the biggest group of losers in the world. It's hard to believe, isn't it? Biggest gamblers in the world, Aussies. Some people think other countries are, but there's been studies done on it. The second behind us is Singapore, and they're about 45% of what we spend on gambling each year per capita. Strange, isn't it? And so Aussies are gamblers. And that gambler type mentality, that flows across into the way we invest. It really does. And people, try and always go and get that great big hit. People come up to me after the workshops that I do for the government or for the National Australia Bank and say, "Oh, Lucas, that was a great workshop. I really enjoyed it. But I've got something that I think is going to do a lot better than that. I've got a cousin's, friend's, brother's, sister that works out in the mines, and they're talking that they've found a new coal seam out in the coal basin somewhere." Oh, that's great. So what I'm going to do is the share price is going to go from 10 cents up to $1.50. So I should make 15 times my money. So I'm going to draw all the equity out of my house and I'm going to be the next Nathan Tinkler. So they do that. Everybody knows the outcome of that. It all goes belly up and they lose all their money. It happens time and time again. And that's that not investor, that's that gambler type mentality. And what we need to do with our investing is actually get away from that. We need to be not thinking about the big one hit. We need to be thinking about building wealth over the long period of time. There's two different ways that we can make money through property or make money through investing as such. There's risky and there's safely. So risky is things like taking share tips, okay? Property development, land speculation, okay? Those are the things, property development, because I'm going to be talking about property today, property development, land speculation and so on, they're risky ways to make money because what happens is they're on time constraints. If you're a property developer, you need to have everything, developed. You need to have DA, BA, you need to have it built, sold, constructed, and the money in the bank within a certain window of time, because if you don't, then interest rates and time will chew your property, will chew your profits up, I should say. And that's why 9 out of 10 developers go broke. So we want to try and get away from that, okay? So we want to go to safe investing, get away from risky investing. And safe investing is buying and holding quality property for indefinitely, for a longer period of time. And rather than time being your enemy, like it is in property development, when we do it safely, time becomes our ally. Okay, so we can hold property for an extended period of time. And what we want to access with our safe property investing is a thing called compound growth. Okay, very, very important. Albert Einstein said that compound growth is the eighth wonder of the world, exponential growth. Lots of different stories about compound growth, and I'll give you a quick one to demonstrate its power. What would you rather? I can give you a suitcase today with $1 million in cash in it that you can go and spend, or I can give you 1 cent doubled every day for a couple of months. What would you take? Let me tell you, take the 1 cent doubled every day for a couple of months, because that works out to be several $1 million. Okay, that's the power of compound growth. Now, how do we access this compound growth through property? Well, it's reasonably simple. So what we got to do is we get our first property there. And I've used an example of $500,000. That doesn't really matter what that figure is. That's just an example. It makes the maths a bit easy. So we buy a property there. Now, the average growth rates on property are around about 8 to 10% per annum in Australia, okay? Don't necessarily need to focus on that too much, but that's about what it is. So as property grows in value, our equity grows, okay? So once our property gets to $550,000, we've got $50,000 worth of equity in there that we can take out and put into property number 2. Then when my 2 properties are growing, let's say I get $50,000 out of each one of those, I've now got $100,000 in growth. I can then go out and get property number 3. Now, how fast you do that is going to depend on a number of different factors. How much equity growth you have in your property portfolio, how fast your personal wages are growing, how fast the rents are growing, what interest rates are like, and so forth. So there's a lot of different factors. But most people will be able to do a property every 2 to 3 years quite comfortably and build up a property portfolio like that. And that is a very safe and stress-free way to build long-term wealth. It really is. So try and get away from that short-term gain where you're looking to risk everything on black. Try and do the tortoise approach and build property wealth over a period of time. Okay, so guys, look, we've gone through part 1 and bang, that is done. Part 1U is complete. So just to quickly recap, What are we going to do? We're going to get our mind right. We're going to set goals. We're not going to procrastinate, and we're going to act upon those goals to make sure that they actually happen. And we're going to be consistent and persistent with entering into our goals. And we're going to look at the long term of what we want to achieve. On top of that as well, we're going to get away from being a risky gambler type investor. We're not just going to go and invest in some silly share that we think is going to double overnight. We're going to invest in quality property that's going to grow over the medium to long term. And we're going to hang on to that forever. And you know what? We're never going to sell it. And we're going to talk about that later as to how we're going to do that. So the guys, that's part one done. So we've gone through, we've had a look at you. Next thing we're going to have a look at is we're going to have a look at finance. Okay, so that's in part 2. That's in the next webinar. So I really hope that you tune into that and have a good look. Rogers Property Group, what do we do for our clients? Just a quick look at us. We provide independent advice for our clients around property investment. We set it up right from the start, so the right financial structures, self-managed super funds, trusts, whether you're buying in your own name. We're going to have a look at all this in the next webinar. We also research locations and statistics for our clients as well. We do cash flow analysis, which is extremely important when you're getting started in any type of property investing. And we help you organise your team, solicitors, accountants, property managers, and so forth. So guys, that's a quick overview of us. I look forward to seeing you again in the next part of the webinar in regards to finance. Thanks very much for listening, guys. See you soon. You can also contact us here.